This is a education video for Integrity Capital, understanding terminology of debt service coverage ratio. This is one of the most important things that you will deal with, that you will understand, that you will probably utilize as a loan associate here at the firm. So let me walk you through this, how we calculate this. So whenever you're looking at somebody's financial statements, whether it's on the P&L side of an investment property or for a owner-occupied, this one's more geared towards owner-occupied, then you're going to look at the gross sales, you deduct the salaries, rent, depreciation, interest expense. There'll probably some more line items, but for the sake of discussion, you come up with a net income. So this net income is $76,000. So you're always going to start looking at the net income of the property. Then you will add back, in most instances for both owner-occupied and investment, the depreciation, because it's a non-cash expense, and then you're going to add back interest carry, because that's going to be going away. So once you add these two back, you get a net cash flow available for debt service, okay, of $176,000. So this number right here is what you have available, or the client has available, to service a new loan. And so this is how we're going to find out whether they can actually be approved or not based upon the cash flow of their business and or the investment property. So let's say, for example, that this person is buying a property for $1 million. And let's say that we're doing a 90% loan to value on an SBA loan. And the interest rate is 4.5%, and the amortization is 25 years. Well, our payment on that would be $121,390 a year. So the debt service coverage formula is very simple. You take the net income, or the cash flow available for debt service, which is this number right here, $176,000. You divide it by the annual debt payment, which is right here, $121,390, and it gives you your ratio. So 176,000 divided by 121 is 1.45 times. The magic number that you have to have as a minimum is 1.25 times. So if you think about it in simplistic terms, here's your cash flow, here's your debt payment. They want to have 25% above break even. So 1 to 1, 1.0 is break even. 25% above is 1.25. They want to have that cushion in order to make sure if anything happens that they still have some room for error and can still afford to make the payment. So the bank, remember, is always trying to reduce their risk, and so they're going to focus on this magic number. In this particular case, we're 1.45 times, so that's 45% above break even. So this is a fantastic thing to know, and it's the debt service coverage ratio that you're going to be dealing with every single day in this business. So you really need to understand this really strong. Again, it's the net income. You add back depreciation, add back interest expense. In some instances, you will add back rent, because rent might be going away if someone's buying a new building and they're renting. To get to a net cash flow available for debt service, then you find out their new loan payment that they want to do based upon the terms and conditions. Find that annual payment, and you divide the net available cash flow for debt service divided by the annual debt payment. That will give you, my friends, the debt service coverage ratio. So that is our education for what is called a DSCR, or debt service coverage ratio.